How to grow your wealth through tax planning. Preface. Why did you start your business? Based on the small business statistics of 2024 compiled by Forbes, 99.9% of businesses across the U.S. are small businesses. Nearly half of all U.S. employees are employed by a small business. Out of the 33.2 million small businesses, 27.1 million are run by a single owner and have no employees. If you own your own business and have been running it for a while, you will agree that running your own business is not an easy thing to do. Not only do you work long hours, but you are also constantly under the pressure of having to live with the uncertainty that comes with owning your own business. So why did you start your own business? Why are you putting in constant hours to make it successful? Because you believe that running your own business will get you closer to achieving your dream. You believe that running your own business will give you the opportunity to change the world by providing better services or products to the people you choose to serve. Hence, your business was not created by accident. Your business was created because of your intention, followed by careful and strategic planning and execution. If you own a profitable business and have been running it for quite some time, you will agree that your tax bill is probably always the largest expense in your business. Hence, when searching for a CPA to work with, most business owners have the expectation that their CPA should help them reduce their tax burden. The problem here is that many business owners fail to realize that tax preparation is not tax planning. Tax preparation happens after the fact. It happens after the tax year, which ends on December 31st of every calendar year. The due date of most business tax returns falls on March 15th, and the due date of all individual tax returns falls on April 15th. If your expectation is that a CPA should be able to apply some magic wand to reduce your tax bill after December 31st, you are most likely missing out on lots of opportunities to greatly reduce your taxes. To reduce your tax burden effectively, you need proper tax planning. Most of the time, business owners perceive tax planning as merely implementing a few tips to cut their tax bills. The reality is that successful tax planning requires careful and strategic planning and execution, just like the approach you have taken to start, grow, and maintain your business. It is true that your CPA plays an important role in guiding you and giving you the right advice and the right tax strategies. However, without a proper implementation and monitoring system, tax planning becomes less effective. You will only scratch the surface without truly benefiting from the real value of what tax planning can bring to you and your business. How to grow your wealth through tax planning. Chapter 1. Why tax planning? The XQ CPA methodology. The U.S. income tax system is based on the idea of voluntary compliance. Under this system, it is the taxpayer's responsibility to report all income. Tax evasion is illegal. One way that people try to avoid paying taxes is by failing to report all or some of their income. Sometimes, people do not report income gained through illegal activities, such as gambling and selling stolen goods. Other times, they do not report all the tips they collect or the money they earn through legal activities, such as garage sales, babysitting, tutoring, or yard work. Such money-making activities are part of the underground economy, which exists as a way to avoid paying taxes. If taxpayers fail to pay what officials say they owe, the IRS can assess a penalty, in addition to collecting the back taxes. In contrast, tax avoidance is perfectly legal. IRS regulations allow taxpayers to claim certain deductions, credits, and adjustments to income. For instance, some homeowners can claim a deduction for interest they pay on a home mortgage. Working parents may be able to claim a credit for childcare expenses. There are also deductions based on the number of family members. These are only a few of the many ways people can legally limit the tax they pay. However, the taxpayer must be able to prove that he or she qualifies. Many people pay more federal income tax than necessary because they misunderstand tax laws and fail to keep good records. Tax planning is a process that you put in place in your business to enable you to avoid overpaying taxes. Why tax planning? Tax planning is important for every business because proper tax planning encourages tax avoidance legally. Tax Planning 360, the XQ CPA methodology. The journey of tax planning begins with you understanding your tax position and then identifying the right strategies that are most effective for you and your business. To practice implementing effective tax strategies, you need to know how to apply them. Tax planning is not all about spending money. At the end of the day, successful tax planning is not just about buying a few pieces of equipment. Successful tax implementation challenges a business owner's ability to think deductively, i.e., how do you maximize your business deductions by justifying that these activities are directly related to the ordinary and necessary part of your business operations. Below, I've provided an overview of XQ CPA's tax planning methodology. I've broken down the whole process into 3 phases. 1. Understand your tax situation and set your tax goal. 2. Strategy selection, tax allocation, and implementation. 3. Strategy evaluation and final tax balance determination. Below, I have outlined a step-by-step approach for each phase to guide you through the tax planning process. Phase 1. Understand your tax situation and set your tax goal. Tax planning starts here. For a business owner, the key to successful tax planning lies in the groundwork laid beforehand. Before diving into specific tax strategies, it's crucial to follow these initial steps. Ensure your financial statements are accurate. Assess your current tax position based on your financial performance, and clearly define your desired tax outcome. Once you have a solid understanding of these factors, you'll be able to choose the most effective tax strategies to achieve your goals. Step 1. Generate accurate financial statements. To develop a relevant and effective plan, as a business owner, you must know your numbers. Your financial statements need to be completed accurately because without understanding your financial performance, i.e., your taxable profit for the year, any tax planning efforts are in vain. Step 2. Understand your tax position. For every taxable profit you've earned, it's important to determine your tax bracket and effective tax rate. Your tax bracket indicates the percentage of tax you'll pay on your income, while your effective tax rate reflects the average rate paid across all income. Additionally, if you owe a balance, you should calculate your anticipated tax balance based on your projected profit for the year. Understanding these figures will help you accurately plan for your tax obligations and manage your cash flow effectively. More importantly, knowing these numbers allows you to assess whether tax planning is a necessary step for optimizing your financial situation. Step 3. Determine your desired tax position. After gaining a clear understanding of your tax position, the most important final step in Phase 1 is to evaluate your satisfaction with the anticipated tax balance. For instance, if you've earned a $100,000 profit, how much of that are you comfortable giving to the IRS? Without any tax planning, you might owe a significant amount, possibly around $37,000, depending on your tax bracket. Would you be content handing over $37,000 of your profit? If not, consider what steps you can take to minimize this liability. Through proper tax planning, you can explore strategies like maximizing deductions, deferring income, or income shifting, all of which can reduce your taxable income and help you avoid paying such a substantial portion of your profit to the IRS. Phase 2. Strategy selection, tax allocation, and implementation. Once your desired tax position is established, it becomes logical to explore various tax strategies, such as maximizing deductions, deferrals, and income shifting. Since each strategy comes with its own set of advantages and disadvantages, it's not advisable to rely on just one or two tax strategies. A more effective method is to understand and consider a range of options, taking advantage of as many strategies as possible. For this reason, we recommend creating a tax strategy allocation model. This model encourages diversification, helping taxpayers avoid limiting themselves to specific tax strategies and instead embrace a broader, more balanced approach. Step 4. Maximize your deductions. There are many types of deductions available for businesses, but a common misconception is that maximizing deductions always means spending money. This is simply not true. In fact, you don't always need to incur expenses to claim deductions. Sometimes, all it takes is a solid understanding of certain IRS rules and taking full advantage of them to maximize your tax savings. Whether or not these deductions require a cash outlay, the key question remains. Do you have the right system in place to capture all these deductions? Have you maximized every possible deduction available to you as a business owner? Step 5. Income shifting. Income shifting focuses on the concept of moving highly taxable income into a lower tax bracket. This can be achieved in various ways. It might involve setting up the right business entity structure to reduce your tax rate, or it could mean lowering your taxable income by employing family members, such as hiring your children to work for your business. Some key questions to consider in this step include: are you operating under the most tax-efficient entity structure? Are you missing opportunities to shift taxable income into a lower bracket? How can you implement income shifting strategies legally without raising red flags with the IRS or triggering an audit? Understanding and applying these strategies wisely can help reduce your overall tax burden while staying compliant with tax laws. Step 6. Deferrals. Deferral is a common tax strategy for business owners, often associated with saving for retirement. The most common retirement vehicle is an SEP, Simplified Employee Pension account. However, an SEP account may not be the best option for all business owners. It is essential to assess your retirement savings needs in alignment with your broader tax planning strategies. Here are some key questions business owners should consider. Do you have the right account set up for your retirement savings? Does your current retirement plan allow you to defer a significant portion of your taxable income until retirement age? Are there more advantageous retirement saving vehicles that could better suit your financial and tax goals? Evaluating your retirement saving options in context of tax planning ensures that you are maximizing both your tax benefits and long-term financial security. Phase 3. strategy evaluation, and final determination. During the tax implementation phase, some business owners may face challenges when certain tax strategies become unfeasible due to cash flow constraints or other business limitations. In such situations, it's crucial for business owners to maintain open communication with their tax planners or tax accountants so that strategies can be adjusted in a timely manner. Not every strategy will suit every business owner. For instance, some deductions require detailed substantiation, and many business owners may struggle to find the time to properly document these deductions. Flexibility and ongoing dialogue are key to navigating these challenges effectively. Below, I have outlined steps that you should consider before reaching the end of the year. Step 7. Strategy evaluation. You may have a great tax plan, but business is ever changing. Do you have a system in place to regularly track your progress? Any changes in your business can directly or indirectly impact your tax position. Even after implementing the tax strategies you have identified, it's just as important to update your financial statements and tax situation before year end. By doing so, you'll be able to assess your current tax position and determine whether you have achieved your desired tax outcome. Regular reviews ensure that your tax plan remains effective and aligned with your tax goal. Step 8. Close the gap. With all the tax strategies you've implemented, do you have adequate supporting documentation to substantiate your deductions before claiming them on your tax return? In this step, it's crucial to ensure that all your deductions are properly backed by records. I recommend sitting down with your tax professional to verify compliance and ensure that any risks in claiming deductions are well calculated. This proactive approach can help you avoid potential issues with the IRS and ensure that your tax strategies taken are IRS audit safe. Step 9. Final tax balance determination. To avoid any underpayment penalties, it is recommended that you pay most of your tax balance by the final quarterly estimated tax due date, which often falls on January 15th of the following year. To do this effectively, it is crucial to know how much you owe before the year ends. In fact, the best approach is to make quarterly estimated tax payments throughout the year. When determining your final tax balance, here are some important questions to consider. What is your tax goal for the year? What was your initial anticipated tax balance? Have you made your estimated payments by the due dates? Are there any additional actions you need to take to achieve your desired tax position? By addressing these questions, you'll ensure that you're on track to meet your tax obligations while minimizing any surprises at your end. Tax planning is a lifestyle. In the last decade, I spent a lot of time introducing businesses to the concept of proactive tax planning. From saving a few hundred to tens of thousands of dollars, I have witnessed many business owners benefit from these strategies. Tax planning not only helped them minimize their tax burden, but it also empowered them to make smarter decisions for their business, knowing when to spend, when to invest, and when to stop spending. If you want to be proactive in reducing your tax bills, have the following in mind. 1. A proper tax plan. Just like creating a business with clear goals and intentions, tax planning requires a well-thought-out strategy allocation model. You won't be successful if you do not have a clear tax plan with specific goals, including how much you're willing to pay to the IRS. 2. An accurate tracking system. Tax planning is ineffective without a proper accounting system to track and monitor all business activities. Accurate records ensure that you can take advantage of all available deductions without worrying about an IRS audit, if it happens. Michael Gerber from the E-Myth Revisited said this: "The difference between great people versus ordinary people is that great people create their lives actively, while everyone else is created by their lives, passively waiting to see where life takes them next." In many ways, tax planning operates under a similar philosophy as successful business management. If you are proactive in determining how to reduce your tax burden, you'll discover that tax planning is a powerful tool for preserving and ultimately growing your wealth. However, if you take a reactive approach, waiting for your CPA to call or blaming your tax advisor for not providing the latest tax-saving strategies, you'll always find yourself behind the curve. If your intention is to run a successful business, I encourage you to invest the time to read this book. By the end, I hope you'll conclude that tax planning must begin immediately if sound financial stewardship is a priority for you. Tax planning is only meaningful if you know your numbers, understand your tax bracket, have a goal of where you want to be, how much tax you really want to pay, and how much effort you are willing to put in. Tax planning is a lifestyle.